Sometimes I'm asked in the comment sections of my videos, why am I willing to invest in high valued or overvalued companies like Tesla or maybe Amazon? And I avoid and often talk down companies like Shopify. We'll talk about that broadly on today's show and give you an update on the company's Q4 earnings, which were released yesterday. What is going on, investors? Hopefully you guys are doing well out there. Time to talk about Shopify, ticker symbol SHOP. Over the last year, stocks down pretty big. Well, a lot of stocks are down 49% year to date, though. Like a lot of stocks, starting to claw back, even after dropping nearly 16% on the news of their Q4 earnings. This stock is still up 25% year to date. Those Q4 earnings came in yesterday after the bell. Revenue coming in at $1.73 billion. We'll have to factor in this is still a $68 billion, probably a little less than that because the market cap doesn't update as this stock goes down during the day. It usually updates the following day. We'll just call it a $60 billion company. They have some cash on the balance sheet. You could do like an enterprise value on this company because they have very few liabilities. So you're looking at a company doing $1.7 billion in their most important quarter. The fourth quarter is the most important quarter for the company. It tends to be the most revenue because you have that holiday shopping season. And the subsequent quarters are going to be lower on a revenue side until you get back to that fourth quarter next year. But you've got explosive growth over here, 25% growth year over year. It beat expectations. They essentially kind of reaffirmed guidance for the upcoming year. They're saying high teens growth for the first quarter. That's about what Wall Street was expecting. The company has pretty predictable revenue, not necessarily predictable, but pretty steady growth on that revenue side. Still a very high growth company, but again, you're paying a massive premium for that as again, you've got like a $60 billion market cap on this one. For the upcoming quarter, that's what Wall Street's expecting. In fact, you're seeing a reacceleration back into 2024. My guess is Wall Street has kind of a recession baked in over the next 12 months or so. And then, things get really good. People start borrowing on their credit cards. Maybe interest rates go down and this company can reaccelerate its revenues. And maybe some of the growth initiatives start kicking in for Shopify. Now, the most recent quarter came in again at that $1.7 billion. That was 25% growth year over year. Last year, you're at $1.4 billion. Company has relatively high margins, especially on the subscription business, but you also have these merchant solutions as well, which is kind of, I believe, like payment processing. Here's your cost of revenues. They came in at $936 million. So off of this, we'll call that $1.7 billion worth of revenue. You have $936 in kind of gross cost. That gives you gross profit right there at about $800 million. Last year, you were closer to about $700 million. So growth on that top side, also growth followed through on the gross profit side. Now, the problem with this company that we've always had is the operating expenses just never seem to turn the corner. We did a video on Palantir a day or two ago. Looks like to me that company's expense structure is starting to normalize a little bit. We're not really seeing that over at Shopify. Now, the sales and marketing has normalized a little bit. It looks like you're trending into kind of that $300 million range. But look at your R&D expenses. They went from $274 all the way up to $440. Look for the full year. They nearly doubled from $854 up to $1.5 billion. Look at your general administrative over the last year from $374, more than basically doubled to $700 million. Look in the most recent quarter. They doubled from $101 million to $214 million. This gives investors no confidence that are we going to sit a year from now and these are going to double again? Because if they double again, it doesn't matter what the revenue growth rate is over the next year unless it's 100%. It's not going to offset this. And in fact, you see this company take a step back from an operating perspective. Last year, operating expenses were $678. This year, $987. So off of $1.7 billion in revenue, you have $936 million in those cost of revenues. That gave you gross profit of $798 million. Now you have operating expenses. This is all your employees, your salaries, your stock-based compensation. You have $987 million of that. So you take $800 million and you minus off $987 and you get a loss from operations at $188 million. Now, this is disappointing because last year they actually generated $14 million in profit. Essentially, they were kind of at break even. And some of us, including myself, thought, well, maybe this company is at a tipping point of profitability. Maybe they're not going to generate these large profits, but they're not going to lose a large amount of money. Well, they didn't do that this year. Look for the full year. They were kind of on that $200 million per quarter run rate. They lost $800 million over 4 quarters. That's essentially $200 million a quarter. You pull down to net income, it paints a similar story, actually even uglier. You come down here to the balance sheet. Here's the most beautiful thing of Shopify's financials. They have a lot of cash. Now, cash has exited the building a little bit, okay? Last year on total current asset side, you had $8.5 billion. Now you're down to $6 billion. Now, luckily, they have basically no liabilities. I say basically, they have about $1.6 billion in liabilities. But look, when you have, that's $5 billion in cash, $1.6 billion is not a tremendous amount. But if you bleed through another $2 billion worth of current assets year over year into next year, again, this is what investors are thinking about. They're not really thinking about this quarter. They're not even really thinking about the first quarter. They're thinking about a year from now. Where are we going to be sitting with this company? Are they going to have less cash? Are they going to continue to bleed money on the operating side and the net income side? That is what people are going to wonder. Now, some of you are going to say, well, this company pays their employees a lot of stock-based compensation. Last year they did $330. This year they ballooned that to $550. So some of you are going to say, well, they're probably generating positive cash flows. So you pull down we're talking about a gigantic net loss of $3.5 billion. Now, most of that loss is chewed up into other equity investments that the company has made into other companies. That was to the tune of $2.9 billion. So you get to add that back in. Stock-based compensation. Pull all the way down to net cash provided by the operating activities over at Shopify, and you were cash flow negative over at this company to the tune of $136 million. Last year, we were positive for the full year at $500 million. I want to remind you guys, we're not talking about a $60 million company. We're not talking even about a $6 billion company. We're talking about a $60 billion company that had their operating profits accelerate to the downside. They had their net income accelerate to the downside. And now their operating cash flows have also turned negative over this company. This is a large reason why this stock is selling off. I am recording this during the regular trade, so this thing could reverse, I guess. But look at these financials. I don't see any reason for that. The company burned through about $853 million of straight cash over the last year. Last year was about $200 million. So again, look, the company's not going to go bankrupt. We're not going to say that here on the channel. They've got years before you start discussing that type of thing. But it starts scratching your head. Based on the business model that this company is trying to employ and the competition that exists, this company is not scaling up in relation to where the market cap is currently with this company. And so some people ask me, why do I avoid companies like Shopify? Why do I avoid a lot of actually the high growth companies outside of just a handful of them? And that is because you look at a company like Tesla, they are transforming an industry. Whether or not they become the dominant EV maker, I don't know, but we are seeing a transformative shift from gas-powered cars to electric vehicles, and Tesla's so far in the lead. When you looked at Amazon 20 years ago, there was a shift from buying nothing online, buying absolutely nothing, to this shift of buying at least a certain percentage of your goods online. And I think we can all agree Amazon won that. And so that is what you're looking for with these hyper growth, high valuation, overvalued type of companies. You're looking for a shift to a new paradigm. Shopify is simply just a solution of a new paradigm. It is not the market leader of a new paradigm, okay? Because you can sell still on Facebook, you could sell your goods on Amazon, you could set up a WordPress site, you could set up a BigCommerce site, you could set up a site on Wix. Shopify is just one tool. Now, they are probably the best tool, and I think they're the best integrated tool, but there are lots and lots of options. So I would not encourage anybody to overpay for this stock. Now, the good news is, from a technical perspective, this is about to set up basically as good as it possibly gets. Now, the stock, obviously, basically nobody has made money on this stock unless you bought it before 2019. If you bought it before 2019, you've made some money on it. If you've bought this stock after 2019, chances are you haven't made a little bit of money, although more recently you might have made some shorter term profits on this. And look, shorter term profits are taxed at the highest rate, depending on what your tax bracket is. Sure, you could double your money or get a 50% winner on a stock, but short-term capital gains at the highest tax bracket are extraordinarily high taxes. Now, without having a discussion on taxes, this stock is pulling back to two areas of support. Okay, you've got this area of support here at 41. That looks kind of interesting. We are also making a series of higher lows. This stock has started to form what we would call an uptrend. You're making a series of of higher highs. That is confirmed by a series of higher lows. It was perfectly acceptable that the stock peaked out just the other day at about $53 per share and is now pulling back to 41, pulls you back to an area of support and this upper trend line, which has only been confirmed by 2 series of higher lows, but it looks pretty good. Now, the stock could go a little bit deeper. It could come all the way back down here to about $35 per share, and you're still kind of churning out this upper trend. It would be a little bit shallower, but anywhere between, I would say, about 35 and 41, if you believe in this company and you believe that somehow this company is going to grow into a $70 billion valuation or a $60 billion valuation and not burn through all their cash in the meantime doing it, well, those are the areas from a technical perspective that I would be looking to buy this one. I am not convinced yet on this stock. Hasn't shown me enough from a financial perspective, but we'll certainly keep an eye on it going forward because they have strong gross margins. They have very few liabilities on the balance sheet. And I think if they can get these operating expenses under control, it's a company that could start printing out some good money, but it just seems like it's a little ways away for Shopify, and shareholders and investors are punishing the stock after those Q4 results. Hopefully, you guys enjoyed today's video. Be back again later today. Good luck with your investments.